We are right in the midst of earnings at the moment. There's a lot of companies coming through. The mining sector hasn't really got going yet, but one of the companies we have seen report numbers is Rio Tinto, and there were some impressive figures. It was a half-year number, dividend up 143%. So those that are long on the stock obviously get rewarded for holding this stock. But it's a good indicator, I think, perhaps possibly maybe if we can put that against the global macro outlook. Let's take this apart now and see just what it means in terms of the big picture with John Meyer from SP Angel. John, good day to you. Just wanted to get your idea, first of all, on the sort of big picture. But I think in the context of Rio, it's always interesting to see these large mining companies because they supply the very basic materials that we all need to see that goes through into manufactured goods that we all buy in the end. So to some degree, it does give us an idea as to what the global macro outlook is looking like.
Well, Rio Tinto, BHP, Glencore and Anglo, they're very important to the global economy. They supply a huge amount of the iron ore, the copper, the nickel that we need to function, not just in the West, but now in China, now that they've developed their economy so far. And the earnings from Rio Tinto today are reflecting the strength of those commodity prices, particularly with iron ore up at over $200 a ton consistently, which are extraordinary prices when you consider that they produce hundreds of millions of tons of iron ore, and the cost of production is around $20 to $30 a ton. So the margins are enormous there. We expect those margins to fall in future years because we can't see China wanting to continue to pay that profit over to Rio's and BHP for such a long time. China has banned imports of thermal coal from Australia for some time, and I personally think that's a move to try and hold back the strength of the Australian dollar, because of course that means that buying from Australia costs them even more, although these transactions are done in US dollars. So well done Rio's today, and to shareholders in Rio's. But what we're seeing is particularly an orientation by these companies towards the battery metal side of things.
Yeah, absolutely. Picking up on that point, I know in the last 24 hours we've been taking apart this proposed deal. I think Rio Tinto has committed something like around about $2.4 billion, hasn't it, to this Jadar lithium borates project in Serbia. How significant is this? So you talk about the way that these companies are now beginning to engage with sort of the future economy, and clearly we've spoken about this before. The electric vehicles market is going to be a big driver of things, and lithium is right in the middle of all this. How big a deal is this for Rio, and how quickly are they going to be able to make this work for shareholders?
Rio Tinto have sat on this project for some years. So it's very interesting to see that they're now going ahead. Yes, it's a very big capital commitment, and they're talking about a full ramp up to 58,000 tons a year of lithium carbonate by 2029. So it doesn't happen tomorrow. So it gives us good longer term confidence in the sustainability of lithium ion batteries for electric vehicles and for other uses going forwards. And remember that lithium is such a light metal that you can replace it with other metals, sure, but those metals are always going to be heavier and probably and possibly even more expensive. So the world is gearing up to the production of more lithium hydroxide. In fact, Rio's are going to produce lithium carbonate, which is a slightly different product that will have to be converted into lithium hydroxide for megafactory and gigafactory use, almost certainly. But the chemistry mix will change slightly over the years. But what it says to us is that Rio Tinto have done their research, and that their markets intelligence department says that lithium demand is here to stay, and this is somewhere where they should be well positioned, particularly with a lithium producer within Europe.
Yeah, John, let me just step back from the corporate and just quickly take a look at the share price on Rio Tinto, because I just wanted to reference this for those that are watching. And this uptick we've seen over the last few years or so, representing this uptick in metals prices as much as anything. I want to steer the conversation around to this company as well, BHP Group. This is the London listed share. Like Rio, it's little moved in today's trade, but it has a long-term uptick in its share price. One other thing I know you're watching about BHP, John, is the takeover of Noront for its nickel discovery in Canada. Again, the same sort of question: how significant is this for the future economy for BHP?
Well, the majors don't buy a lot of junior mining companies, and when they do, the market sits up and listens. And the message again here is moving into battery metals, because there isn't enough nickel in the world, and Benchmark Minerals highlighted this earlier this week, in that there are supply side issues with production of nickel hydroxide, which is what's needed for these gigafactories and mega factories, and that Chinese battery manufacturers are struggling to get the nickel hydroxide. In fact, they're limiting the battery production in China at the moment because they just can't get the raw materials. And if you think, China's been very, very forward in getting hold of new production and developing nickel production in Indonesia, for example, and yet they still can't get as much as they want, because electric vehicle growth and production growth and electric vehicle demand is exceeding virtually all expectations.
Just wanted to reference the nickel price if we can, because this is coming up to an interesting inflection point. In fact, we've got the chart, if we look at the chart where we are at the moment, very close to recent highs, and the highest we've seen since the beginning, certainly of this year and more. But this is, it's not just nickel. I mean, we're talking about a lot of these things. You referenced lithium earlier. We've got this copper price flirting once again with the 10,000 level. How much of this is really all about the way that people view the outlook for the economy? Because the IMF, I think, have recently come out to say that the global economy generally, they're talking about a 6% rise in GDP this year. What about GDP in the context of the big picture, and Asia particularly against the West?
Well, the IMF came out, and they're normally a bit behind the curve, but in this case, they seem to be quite up with events. And they pulled back GDP growth estimates or expectations for Asia. They pulled back China to 8.1% from, I think it was 8.4%. Now, that doesn't sound like a huge move, but actually, when you consider the scale of the Chinese economy, it's a cautious pulling back. And what we see is Chinese policymakers already moving very quickly to stimulate automotive demand through the second half. So we're expecting to see cashbacks, tax cuts, increasing numbers of number plate authorizations, because in certain cities like Beijing, you have to apply to have a number plate so you can actually drive into the city and things like that. So what they're able to do very effectively is stimulate new demand for cars, and that's what they're looking at doing in China, and that will stimulate the demand. And we know that in China, the proportion of electric vehicles being sold is very, very high at the moment. So, and in fact, if anything, I think that's likely to increase, because they're more likely to stimulate the demand for the electric vehicles than for the combustion engines. And we know that this is a good way of helping the economy and keeping everything going.
It's interesting, isn't it, talking about that in the context of China, because in the West, they're talking at ways of trying to bring back in some of the liquidity. As at the time of speaking to you, John, we're awaiting the Federal Reserve interest rate decision. But we've got Jackson Hole at the end of August. Then we've got the next Fed meeting and the next round of central bank meetings coming into September, when we could well see a little bit of an uptick in terms of some of the rhetoric about trying to find ways of reining in some of the potential inflation in the economies. How do you see the mining sector moving and metals prices moving, given what you said about China and the prospects for slightly tighter money here in the West?
Well, the situation we're in is that every time there seems to be a bit of a hiccup in the global economy, let's say there's more cases of coronavirus in Nanjing, or things slow somewhere else in the world, then the policymakers step in with a bit more stimulus. So every piece of bad news seems to be accompanied with a piece of good news right now. And probably the stimulus has a greater impact on metals demand than the lack of growth that we might have seen. So it feels like 2 steps back and 3 steps forwards at the moment. And that's not a bad place to be. And given that we've got this huge transition from fossil fuel-led economy to something that's a bit more electrically powered and with more renewable energy generation, that plays to greater demand, particularly for certain types of metals. We're talking lithium, rare earths, copper, particularly nickel, tin. These, and in fact, what we're seeing now in the United States is big premiums being paid to get hold of copper, nickel, tin in the markets, because the logistical chains aren't working quite as well as they should. And there's a lot of tin, for example, in Asia, in warehouses, but it's not, in fact, a lot of that's over in Taiwan. and it's not in the United States at the moment. So they're having to pay up to draw metal from Asia back into the United States as they get their own economy going again.
And of course, at the same time, China's trying to lower prices of metals, aren't they? They've tried to put in place some strategy to try and mitigate pricing. It doesn't seem to be working. I mean, I'll just show the nickel chart, but I mean, other charts as well ticking up again. Is China going to get its way, or is it going to have to suffer these higher prices, do you think? And do you think prices for the rest of the year will more than likely continue to rise?
Well, they're very careful about this policy because they know it could fail quite easily. So what they did was they talked the market down very effectively at the time. I think what happened was a lot of US and Western funds just took money off the table, and copper prices, which were over $10,000 a ton at the time, pulled back to about 9,200, 9,100. But what we've seen is that there is still ongoing strong demand for copper, and prices are closing in on $10,000 a ton again. So, and that's despite the Chinese lobbing a fair amount of copper metal back into the market as a second attempt to try and push prices down. So I think they know that they've got to be very careful about this, because it's a policy that can backfire on them very easily. And if they chuck too much of their reserve stockpile into the market, they won't have any firepower left, and prices will just take off again.
Okay, John, look, we'll leave it there, but thanks for joining us. John Meyer from SP Angel with an update on the global macro outlook in the context of some of the deals that are being seen in the mining sector at the moment and those Rio Tinto numbers. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.